We're looking at the oscillator. This is what we're calling the turning point radar, because what it's doing is it's following the moods of the market. And you notice how regularly they go up and down. They don't go up and down the same amount. The amplitude of these moves are different each time. But you can see that the intervals, the times that people get too happy or too scared and change their mood, these are very uniform. And that's why it's relatively easy to be in the right place at the right time in terms of a relatively short-term trade. And what you can see is we're really not at a favorable entry point or exit point. We're kind of stuck in the middle. What's happening is sellers are really not eager to sell. The stock market's been weak, and so you would think that there was a lot of selling. It isn't really true. There isn't a lot of selling. What we have is that buyers are not particularly motivated. Buyers, when the market gets overdone to the downside, some buyers come in, but as soon as we get up to a normal level, they are willing to take profits. So we don't have a lot of selling. Selling pressure is as low as it has been in the whole bull market since 2009. But demand just isn't there for stocks. Here we are 10 years into this maturing bull market, and we always have had the discipline to start our process by saying, first of all, if I could only own one company, would I be satisfied with this company as my choice? The answer is, in many cases, the stocks that we've been following, yes. They're very well run, they have a wonderful future, and the world is going to want and need their products. They do it right. So yes, I would be satisfied with each of them. But now here's the question. The second part of this is, would I buy shares in this company today if the stock market was going to close for 10 years as of tomorrow? And the answer is, for many of these companies, the answer is no. I would not buy Viva if the stock market was going to close for 10 years, because Viva is a company, a stock that's going to be pulled down by the market. And no, I would not want to be stuck in that stock for 10 years. Now here's the crucial difference between where we've been and where we are now. Now, no answer to this crucial question doesn't mean I'm not going to follow the stock. It doesn't mean it's a good stock, and it doesn't mean that I might not own it a lot of the time in my life. Maybe I will. But today, the make or break question is based on this company's profits, profit growth, sales, and sales growth now and in the immediate future. Is this stock a good deal? Is this stock the best use of my capital today, owning and holding that stock? Note that this is a question about the price. It doesn't mean, is it a good company? It doesn't mean, is the company going to be profitable? The question is, how much am I paying to be a partner in that company? Because if I pay too much, then there's likelihood is that I'm not really going to make money. I'm probably going to have trouble over the next 10 or 20 years if I buy a stock and pay too much for it. A lot of these stocks are at the upper end of their range. Now I want to show you a stock that means a lot, that is not at the upper range, although you can see that it's been rallying strongly. Micron Technology makes two kinds of chips that they specialize in. One is called DRAM, that's dynamic random access memory. And it's a kind of a semiconductor or a chip. It stores each little bit of data in a tiny capacitor inside an integrated circuit. Now they can be charged or discharged, but the bottom line is that what companies are needing now is they need powerful DRAM, but they also need high performance DRAM called LP DRAM. So the thing is that the DRAM is about 70% of Micron Technology's sales, and they're growing by 20% a year. The demand for DRAM from Micron Technology is growing about 20% a year. Now, there's one other thing that they make that's the other 30% of their production, or roughly, and that is what's called NAND, N-A-N-D. Now, NAND is actually a mathematical formula is what it stands for. But what it means is it is a kind of a chip that can hold onto memory without having any electricity in it. Think about how interesting and complicated that is. It's storing electronic data, and it's working because it's got electricity. When you turn off the electricity, years ago, that would mean you wouldn't have any memory. Or you would just assume that if you turn off the electricity and you turn it on again, you're starting over. The thing about NAND is that it is a kind of memory storage that doesn't need any electricity. Remember, both of these are about rapid transmission of data, storing of data with very little power and as cheaply as possible, storing as much data as possible so that you can put it in these wafer-thin new devices, but also to use very little power so that the battery can last a long time. The worst thing we do right now is batteries. And also that you have to be able to turn it off and it holds onto the memory. So these are things that are required in everything that we're doing. Micron is a leader in these things. And each of them allows for increased speed and system performance, saving resources in hardware and in software development. So the bottom line is the demand is taking off. It's happening everywhere. Even in Europe with a downturn, they're still going to be developing, but more importantly, the rest of the world, Africa, East Asia, South America, they're Americanizing. They're getting all the things we take for granted. Many of them don't even have electricity, but they do have smartphones. They know how we live. They demand all of it, and it takes these Micron Technology chips for them to get what they want. Now you see that the stock is way up there at its high, but the thing is it's not particularly expensive. What I want to show you is how volatile it is. The purple line here is Intel. Notice how much Micron Technology stock moves compared to Intel. Now, in terms of the value, let me show you something. Micron Technology has a forward PE of about 5.5. The stock is up, the profits are up 130% this year. They're going to probably go between 30 and 40% gain per year over the next 5 years. It's got almost a 50% return on equity. Compare this to Intel, which has a much slower growth rate, much higher price to earnings ratio. How is it possible? Well, you see, the reason that Micron Technology's stock is so volatile and the reason it gets such a low price to earnings ratio is because it moves a lot. That is the outstanding characteristic of the people. It's really more about the people who buy the stock than it is about the company itself. But since it is so volatile, it gives me an opportunity to make money without having to be too good at predicting the future. So one of the things that I want to do here, I have identified a habit of Micron Technology. Over the last 2 years, which I'm showing you here, this is simply a short-term trade. It's a non-directional trade. I don't have to tell the future. I'm simply taking advantage of mistakes in the market, because there are a lot of people who like to speculate on what's going to happen with the earnings report. Now, the earnings report is going to be for Micron Technology. The next one is 620. Of course, they report their profits every 3 months, 4 times a year. I don't want to bet on that, but there's going to be a lot of people that are speculating on that. What I know is that there has always been a run-up, anticipating a run-up at the earnings for the 2 weeks before they report earnings. It's happened 7 out of 8 times in the last 2 years, and it's happened every time in the last 1 year, each time, 4 out of 4. So what I'm going to do is I am going to buy a roughly at the market 50 delta. That means at the market. It means it's going to move in a 30-day option. It means it's going to move about 50 cents for every dollar that the stock moves. So that's right at the money, roughly. And what I'm going to do is I'm going to buy 100 or 1 contract of that delta call, or 4 contracts, whatever you want. But what's going to happen is, and what has happened each time is, I'm going to buy that 14 days before earnings, which means on the 6th, which is 2 days from now. But I'm going to sell it 1 day before the earnings report. That means I'm going to sell it on the 19th. I'm not going to make a guess on what the profits are going to be. Doing that has resulted in 7 out of 8 wins in the last 2 years, 4 out of 4 wins in the last 1 year, with a percent return of about almost 900%, almost 3 times what I've made by owning the stock all the time. So here's a chance for me to make money based on people wanting to speculate, driving up the price of that option, coming into the earnings, and then I'm going to be out of it before we ever find out whether the profits were high or not. So that's an easy trade, makes money almost all the time.
So let's take a look at the step-by-step simple clicks here involved in actually executing this trade. Again, we are taking advantage of those emotional investors that typically within 14 days of the earnings call for Micron Technologies, ticker MU, generally drive the price up. So here we are, you can see my cursor. We're looking at the options chain for Micron Technology, MU. Just like Daniel said, as of Tuesday, June 5th, there are 31 days to this July 6th expiration of this options chain, so that's as close to 30 days out as we can get. And again, we are buying this 14 days before the earnings call. So we're buying this Wednesday, June 6th, and we are going to sell this 1 day before the earnings call because we don't want to get involved in the emotion. This is a play on the emotions. We don't want to become part of the emotions. So we're looking for a 50 delta call option to buy. And if you do not have this delta column in your trading software, you are in big time trouble. You need to be using software that shows you the deltas, right? The amount of movement that you're getting in your option for every dollar's worth of movement in the underlying stock, which in this case is Micron Technology. So we want 50 deltas, okay? So here we go, 0.499. That's as close as we can get to 0.50 without being any farther away. So here is the call option, and there it is. It just clicked at 50 that we are going to buy. So this is our option here. They are currently asking anywhere between $3.25 and $3.35. This is the price that they want you to buy it at. So to start this trade, we'll click this button. The little box opens up that says, here's all the information. So here we are, Micron Technologies with an expiration of July 6, 2018. That's 31 days away. That's as close to 30 days away as we can get. We want to buy it. So buy there is highlighted, and we are on the calls side of the screen, so we know we're buying a call. We only want to buy one, so the quantity is 1 here. So what do we want to pay for this? For ease sake, we're just going to buy this at the price that they are asking. We're going to buy this at $3.35. When you really do this, you're going to try to get it for a couple cents cheaper, but for showing's sake here, we're going to stick with that. So there we go. We want to only buy this today. We don't want this trade to carry into tomorrow. So we're all set. We just click submit. It then gives us this other pop-up box that says, do you want to do this stuff? You're buying one call option. Here's your expiration date, the price, and everything. We say yes, transmit, and then boom, look out down here. Here we go. We bought that call option. It's that easy.
Now I'm going to show you another way to do this, and maybe you want to do this too. This is not particularly more sophisticated. It's actually a less risky trade. The other one has a very high percentage of gains, but that's in the past. What I am going to bet on here is, again, take a look at the volatility of Micron Technology compared to the rest of the market. I'm going to buy a out of the money 25 delta call. That's a couple of strikes out of the money. I'm going to buy a call option and I'm going to buy a put option. Now these are relatively low priced options, but there's a characteristic of options that stocks don't have. When I'm buying an option that's out of the money, it's very cheap, but as it gets closer and closer to being in the money, the price escalates. The price curves up, accelerate. The same thing happens with the put option if the stock goes down. I started out of the money. That means I had a strike price on that put option above the price that the stock is now by a couple of strikes. But what I can do, what happens is if that stock goes down as it gets closer and closer to the strike price of my put option, as it gets closer and closer, it's the value of that put option is going to accelerate. Now, I'm going to have a call and a put. Whichever one is right, it's going to move in one direction or the other. You see that it's volatile. Whichever direction it moves, that one is going to become more influential and the delta is going to be higher, and the effect on the stock, the effect on the option is that it's going to accelerate on the winning side. It's going to decelerate on the losing side. The further that stock price gets away from the losing side, the less effect it's going to have on the price of the option. The more it gets closer on the winning side, the bigger the move in the option is going to be. So what I'm getting is a special leverage that's unique to options when you are holding a strangle, buying both a put and a call. Over the last couple of years, this has resulted in an 800% return, about 10 times the money that you've made on the stock itself. And no matter which direction it goes, I'm going to get the same thing. I'm going to have the same benefit. Now, what I am going to do, though, is I'm going to avoid the earnings reports. I'm going to hold this all the time, but I'm going to end these positions 2 days, 1 day before earnings, and then I'm going to start them again 2 days after the earnings. It turns out that regardless of which direction the earnings go, that being involved in that earnings means you're trying to guess in the short term what's going to happen. I'm betting on the volatility of this stock and only that. So it doesn't matter to me which direction it goes. All I know is that I'm going to be far enough out of the money so that the winning side is going to make me a lot of money. The losing side is going to lose me only a little bit of money. It just so happens that's the way this very volatile stock moves. But remember, don't hold it as during the time that the earnings are being reported. These numbers that I'm showing you are true as long as you are out of it during the earnings report.
So let's look at this next trade here in Micro Technologies. Again, the ticker is MU. This is a different trade because this trade is saying that we believe there's going to be movement in the underlying stock price, but we don't want to guess which way it moves. And this is the best way to play that, in my opinion. So again, we're here at Micron Technologies up here in the corner. So Dan said, let's buy a 25 delta call option and a $25 put option with about 30 days to expiration. So here we are. We're still on the July 6th, 2018 options chain as of Tuesday, June 5th. This gives us 31 days to expiration, so that is close enough. And since we don't want to necessarily do each of these trades, meaning buy the call and buy the put separately, we're going to use the strategy builder function so we buy both the call and the put at the same time, because we don't want to get hung out to dry with only buying the call or only buying the put. So coming down here to the strategy builder, which I just clicked the little tab and turned it on. This allows us to do the whole trade at the same time. So again, we want to buy that out of the money, only 25 deltas on the call option. So the calls are always on the left-hand side of the screen. Here is the delta column. Again, if you do not have a delta column in your trading, get something else because you can't do it without this. And we wanted about 25 deltas. So let's see, almost 24 is closer to 25 than 27. So I'm going to go with this $67 strike price right here. They want us to pay pretty close spread, anywhere between $1.21 and $1.25. So again, when you do this for real, you're going to try to get a couple cents cheaper on this if you've got the time to look at it. If you don't, you can just do it the way I'm going to do it here. So we're going to buy this 25 delta call option right here. See how this populates down here in our strategy builder. And on the put side, which is always on the right-hand side of your options chain, we are looking again at the deltas. And again, we want 25 deltas or as close as possible. And it looks like this $54 strike price is as close as we are going to get. Pretty small spread here, only 3 cents. So we're going to buy this put option here for $1.48. Again, it populates my strategy builder down here. So those are all the legs of this trade. And then I can just come over here and simply submit my order. It'll do it all at once. Yes, that is the strategy that I want to buy. That just lets you double check it. We transmit and boom. And there we go. Bought it. Bought them right down here. There we go. Very, very, very simple. That is the strangle that we wanted.
The next stock that I want to show you is Tanger Factory Outlets. You notice that this stock is way, way down. It's been falling a lot. The reason it's falling is because of the belief in the market that brick and mortar stores are dying because they're being completely replaced by Amazon.com. Well, the fact is, it is true of department stores, but it is not true of these Tanger factory outlets. When you go there, they're packed. They're full all the time. And they have very few vacancies. So the Tanger Factory Outlets Company, SKT, actually pays about a 7% dividend. And it's a very good value because they are having about 30% more profit for the quarter this year than they had for the quarter last year. And even though they have had a couple of companies go bankrupt, mostly the stores in those outlets are doing great. So the profits are up 30%, even though the revenues are about flat. So again, owning that stock is a great idea. It's going to earn me a 7% dividend. And if I own the stock, I can sell a call option on it and earn almost 10% a year by selling call options on the stock. And I don't have to worry if it goes up or not. Now, the thing is, the reason people are not getting that value of this stock now, but they will, is that I look at in a real estate investment trust the funds from operation, not the price to earnings ratio. You see, the price to earnings ratio, it's a real estate. It's very asset intensive, and so there's a lot of depreciation. And so there's a lot of tax write-offs against the earnings. So the earnings make the stock look more expensive than it is. But if you look at the funds from operation, which is essentially the cash flow, the rent, you can see that it's selling at a very low multiple compared to other real estate investment trusts. And who wouldn't want to buy a store, a place, a factory outlets place that's full at 8 times the money that it makes for you? It's paying a 6.7% dividend, covered at only about 60% of the money they make. And the stock is at a 5-year low because of people worrying about Amazon. So what I'm going to do with this stock right now is buying the stock is fine. But the smartest thing I can do with it is to sell a put option. See, since the stock is going down, the people who own that stock are buying put options to try to protect themselves. They're buying it as a hedge against the stock going down. But other people are speculating and buying put options to bet on the stock going down. But either way, what's happening is that they're paying a lot of money for those put options. So what I'm going to do is I'm going to sell. The stock's at about 21 3/4 right now, just under $22 a share. I'm going to sell a $20 put option. I'm going to sell it to the people who are speculating. They're buying it to either protect themselves or to speculate on the downside. I think this stock is a great deal, and I'd be happy to buy it at 20. The problem is the stock's around 22. I can't buy it for 20. I'd be happy to buy it for 20. So what I'm going to do is sell a put option to that speculator who's paying too much for it. He's going to pay me roughly 60 cents for each share. He's going to pay me, therefore, if I do it 4 contracts, the dividend on 200 shares is $300. And if I simply sell a put and I don't even get to own the stock, and the stock never goes down to 20, I can keep selling that put. And I make more money on selling that put option and receiving that premium than I do on the dividend. My annualized premium for doing this, what I'm doing is it's a September 21st put. It's 3 months. So my premium is times 4 for the annual premium. I'm doing it for about 60 cents. I'm coming out with about $2.40 on a $22 stock. So I'm making more than 10%. My annualized take on that put, and I get this cash immediately when I sell the put. I don't wait around. I get paid right away as soon as I sell the put option. Do that 4 times a year. I come out with a premium of $480. I'm actually making more money selling those put options than I would be if I actually owned the stock. I'm taking far less risk because I don't own anything. The worst thing that will happen is if the stock goes down to 20, I will get to buy the stock which I want at 20. Then the dividend will be more like 7.2% instead of 6.7 because the dividend is going to stay the same. The stock price will go down. So, very simple, easy trade, doesn't require a lot of guessing.
And here is the step-by-step clicks of the Tangier Factory outlet trade. SKT is that ticker. So again, taking advantage of those speculators that want to buy put options, right? They want to buy insurance after the house has already burned down, in essence, because most of these traders buy these options at the wrong time, and we will let them all day long, and we're taking advantage of them. So Dan said, let's sell the September 21st, 2018 option. So here we are, September 21st, 2018. As of Tuesday, June 5th, there is 180 days to expiration right there. And Dan said to sell the $20 or the 20 strike put option. So again, the puts are always on the right side. Here is our strike column. Here's our 20 strike. And we can get anywhere between 45 cents and 55 cents for each contract. So let's sell this, open up this position. Bingo. We want to sell this put to start this chain, right? Shoots it down here in our strategy builder, which I didn't have to use for this trade because it's only one leg of a trade. But yes, we want to sell that September 21st, 2018 $20 strike put option, and we're instantly going to make 45 bucks here by the click of the button here. Submit order. Gives you the pop-up, do you really want to do all this? You check it out, you say, yes, it's right for me, transmit, and boom, and there we go. We were simulated. We instantly made $45 on this trade. Obviously, that doesn't sound like a lot of money. I just sold one trade in this example. You can sell many more if you want to, but just for this example, we just did one. Hope this helps. Thanks so much.